Okay. Good morning, everyone. My name is Gad Lebanon. I'm Chief Economist, North America here at the Conference Board. Welcome to our April edition of Economics Watch. We have an exciting hour ahead of us. What are some of the main questions that we're going to talk about? First, can the fast growth in emerging countries and Europe continue, or are we expecting them to slow at some point? That's one question that we'll tackle here. In terms of the United States, we had some disruptions lately, the potential trade war and the drop in stock prices, especially technology stock prices. How is that changing our outlook and view of future growth in the US? As a special topic here, we're going to focus about trade, and in recent years, the trade in the globe has been accelerating. Is that a one-off or a new trend? We are going to talk about that as well with some of our guests here. And if we expect trade not to continue growing as rapidly, what does that mean in terms of reshoring? Are we likely to see a lot more of that? So those are some of the topics that we will discuss in the webcast. To help your viewing experience, just a few tips. First of all, if you have questions, as usual, no need to wait until the end. Just please write them at the chat box at the bottom left of your screen, and we'll take them as they come. To download the presentation, you can do it through the file download pod at the bottom center of your screen. You can view the video or the PowerPoint at full screen by clicking the 4 arrows at the top right of your screen. If you have a minute at the end, we'll appreciate if you take a brief, complete a brief evaluation so we can make our future webcasts even better. And finally, if you want to watch this webcast again or share it with colleagues, it will be available approximately 48 hours after the webcast on our website. Also, if you are interested in CPE credits, they are available for this webcast. You need to type your full name and email address in the space provided. Click OK for 3 pop-ups that will occur during the program. You need to stay online for the entire webcast to get the CPE, and credit is available for live participation only. I want to introduce my guest here today. So first, on the far right of me, as usual, Brian Shaitkin, who's always here, a senior economist at the Conference Board. Good morning, Brian.
Thanks, Gad, and looking forward to giving everyone the latest up-to-the-minute trade policy update today.
Yeah, up to the minute. And we have two of my other colleagues here to the right of me, Eric Lund, the senior economist at the Conference Board and one of the main authors and economists working on our trade initiative. Good morning and welcome, Eric.
Good morning. It's good to be here. I look forward to the conversation.
Good. And from Europe, a senior economist, Abdul Arumban. He is our economist responsible for emerging markets and also a co-author on the trade initiative. Welcome, Abdul.
Thank you, Gad, and it's nice to be back on the Econ Watch. I'm looking forward to it.
Good. So without any further introductions, let's move to the global economy. And Abdul, what are the main new developments there? Are we expecting to continue to grow rapidly or slow down?
Thank you, Gad. It's a big question whether we are expecting a rapid growth acceleration or not. But in general, global economy has benefited from a revival in investment in several mature economies, improving business and consumer confidence in both some of the mature economies and also some of the emerging market economies, improving labor market conditions, increased commodity prices, and faster trade growth. The last point we will talk about a little bit more later. So growth in 2017 actually improved by more than half a percentage point compared to 2016. And we are expecting this trend will have some positive impact continuing in 2018 as well, and the growth will improve, but not to the same extent. So we are expecting growth to improve from 3.2% in 2017 to 3.3% in 2018, Gary.
Good.
Yeah. So I think both emerging markets as well as advanced economies will feel this improvement, but the emerging market will have much more challenges than the mature economies in coming ahead. Within the mature economies in Europe, first half of the 2018 will remain stronger, but later part of the year will have much more challenges. For example, wage growth has been moderating in many of the Western economies, Western European countries. Trade has played a significant role in the growth surge during the last 6 months in Europe, but it remains a big question whether that can be sustained in the remaining part of the year, given the uncertainties about the trade policies from the United States. Consumer spending has weakened significantly in Europe, and the economic sentiment has been weakening in industry, services, and retail sector of the European economy. So there are significant challenges for the remaining part of the year in Europe. And when it comes to the emerging markets, the growth momentum is sustaining, but still, again, they also have significant challenges coming out from the potential decline in China and also the trade uncertainties around the trade. So in particular, their export has been hampered significantly by the strengthening of US dollar. So the future of trade really has a significant impact on their outlook. So overall, we expect some strengthening in the growth, but how strong it will depend upon how the trade policies are going to shape in the coming months, Gary.
Yeah. Thank you, Abdul. And we'll hear more about China from Eric in a few minutes, but Abdul, let's start. One of the main tools that we have in analyzing future trends is our global LEI, Leading Economic Index. What is it telling us?
Yeah, so the global leading economic indicators is suggesting a positive momentum, and that positive momentum is everywhere across all the countries and all the regions which we have in this actually. So this chart basically gives you the cumulative contribution of individual countries and regions to global leading economic indicator growth rate, 6 months growth rate of global leading economic indicator. And as you can see in the last bar, where you have United States, which is the red, where you see an expansion. We see an expansion in euro areas contribution. We also see expansions in emerging markets, especially in China. China is really contributing significantly to this momentum, but of course there are significant downward risk for China as well, because the liquidity conditions and the credit market conditions in China is really getting tighter, and the policy focus is shifting from growth to deleveraging and correcting its already accumulated financial risks. So we are not expecting a significant growth momentum to happen there. But the interesting thing is that, or the important thing to be seen here is that, so the expansion in the business cycle is synchronized across all the regions of the world and major regions of the world, and so that significantly suggests that there is no significant threat for a recession coming over in the ongoing year. But we expect an expansion or an improvement in growth rate in going forward in 2018.
Good, and we see in this slide, we see the actual leading economic indexes for several of the countries or regions. They all look pretty good, far from zero. So as you said, no indication of a recession anywhere.
That is true. There is no indication of recession anywhere, but we also have to note that the pace of expansion or the pace of growth rate in the leading economic indicators is declining in everywhere. Despite the fact that it is still in the expansion phase, the growth rate has declined. If you look at India, China, Brazil, everywhere. So the expansion, the rate of expansion is declining. So that basically suggests that economic growth will, of course, continue. But again, the rate of growth maybe it may not be in an extremely high acceleration phase in the year.
Abdul, what indicators are responsible in general for these slowdowns? And then maybe, Eric, you can elaborate when you get to the China slide about what some of the particular slowdowns in the Chinese LEI are.
So there are a lot of significantly a lot of sentiments factors which are playing a significant role in. For example, in Brazil, as we know that economic sentiments about the Brazil is now affected by two factors, significantly affected by the upcoming election in Brazil, which is attributing a lot of uncertainty among investors and kind of wait and see. So this feeds into purchasing managers index and also the industrial production and investment in Brazil. So a lot of information regarding the sentiments, economic sentiment is playing a negative role in bringing the growth downward, Brian.
Good. And Eric, as we look at the red line here, we suggested,
sorry.
No, it's fine. That in China, the LEI is still growing rapidly, but perhaps not accelerating further. What is our view on the China growth?
No, I mean, as you saw in the previous chart, that the Chinese LEI has sort of been leading the pack in a lot of ways over the last year or 2 years in terms of its expansion. But we did see a downtick at the last reading. China's economy, especially last year, was doing fairly well. And in the first few months of 2018, most of the macro indicators that they've put out have supported a narrative that the economy is continuing to do well up until the March data. And as you can see in the chart that's currently on the screen, we take a look at some of the PMIs that are coming out of China for services and manufacturing, and there has been a steep decline. It's challenging to read what is going on in China's economy at the beginning of the year. There is a very large holiday, the Chinese New Year, which is sort of like a combination of Christmas and New Year's and Thanksgiving all rolled into one. Because it shifts around, it really muffles the data.
It also muffles the increase or just the recent decline? I mean, do you think both?
No, so the most recent numbers are from March, and so they should be clean. Okay. So a lot of the numbers that came out in Jan and Feb were artificially inflated due to base effects associated with the timing of the New Year's this year versus last year. Mm-hmm. And so we've seen in the early March data, like the PMIs, an expected sort of deceleration in the growth. What we basically had last year was a great deal of investment that was associated with sensitive political events in the country. We had the 19th Party Congress, which occurred at the end of the year. And there was an incentive among policymakers to try to really sort of spur the economy on and sort of inspire confidence among consumers and business people inside of China. But the priorities for this year are a little bit different. We've seen statements coming out of Beijing related to issues like de-risking or de-leveraging the economy, with Abdul mentioned just a minute ago. So we're really expecting to see a lot less infrastructure investment inside of the country. We're also seeing the housing market cool down in China as well, which is a big growth driver due to upstream sort of inputs that go into that vis-a-vis construction materials and furniture and things like that. But on the whole, we continue to see consumption to be performing sort of the best among its peers in terms of GDP components are concerned. So, consumption growth is continuing to and will continue to play a greater sort of force in the economy as these sort of more antiquated, older growth model components like infrastructure investment start to step down. But the overall effect of this is going to be a continued sort of maturation and slowdown of the economy over the next 5 to 10 years.
Good. So summing up the global situation, I think the global economy is still growing strong, but compared to a month or two ago, I think there's a general feeling at the conference board that we are more concerned that this fast growth will not continue, although we're not seeing a major slowdown either. Would that sum up the overall global economy, would you say?
I think so, yeah.
Okay, good. So let's move to the US economy. And before I hand it off to Brian, let's see what our audience thinks. So there is a poll question here. Which economic risk is your firm most concerned about in 2018? The first option is the possibility of a global growth slowdown, rising trade policy uncertainty, recent struggles of major technology firms. So those are three risks, and let's see what our audience thinks. I'll give you a few more seconds to consider if you are certain in your answer. So 5, 4, 3, 2, 1, 0. So we're closing the survey. Okay, interesting results. About half are saying that they're concerned about trade the most, trade policy. About 1/3 think that they are concerned, as some in the conference board, about a global slowdown, and only 1/6 are worried about struggles of major technology firms. Any immediate reactions? I assume we're going to talk about some of those topics later in the webcast, but just some reactions. How would you vote if you are part of the survey?
No, please go ahead.
So I think, first of all, our audience came to the right place if they want to learn everything about trade policy risks, both short-term and long-term. I think all three of these risks are compelling. Of them, I think the technology stocks perhaps have the biggest downside, but maybe the lowest probability of that downside emerging. Trade policy, I think the risks are quite apparent and already real. And so generally, I agree with our audience's assessment of these three risks. I think all three, as I'll get into in a moment, are important in thinking about the present US and global business environment.
Eric?
Not really much to add to Brian's statement. I mean, the outcome of this poll, I think, in some ways, is going to be driven by sort of content and headlines. And I think certainly recent headlines have been focused a little more on trade than on technology firms. But in general, going beyond that, as far as the threats to U.S. and sort of multinational businesses are concerned, I think the trade policy one is most likely the scariest and most probable of actually manifesting at this point.
Abdul, anything to add?
No, I think to largely I am in agreement with this result. So basically, I would have expected a little bit more votes for the trade policy uncertainty than what it got now, and the possibility of a global growth slowdown. The probability I would have reduced a little bit. So my vote would be, obviously the first vote would be for the rising trade policy uncertainty at the moment.
Good. And maybe if we took the survey if in an hour or two when Zuckerberg finished his testimony, maybe the results would have been different.
Or after we get a tweet from the president, possibly. It could adjust it all again.
Yeah, and there also missiles, maybe going to Syria very soon. So a lot of things to look forward to. Brian, what's new at the U.S.?
What's new? I think this has been a pretty interesting month in terms of thinking about the U.S. economic outlook. First of all, though, I think it's important to stress that we still are confident of pretty robust growth in 2018 and 2019. Our forecast still has 2.8% for 2018, 3% for 2019. That 2.8 figure is down from 3% last month for some of the reasons I'll get into in just a moment. But on the positive side, why is the outlook still so strong? Two factors. First of all, business and consumer confidence remain very robust in comparison to what we saw Abdul and Eric talk about in discussing the emerging market outlook, where you're starting to see much more of a waning in confidence at a pretty high level. You're not seeing that quite yet in the US. And in addition, businesses still feel like the fiscal measures that have been implemented, the afterglow of the new tax policies, are boosting that confidence. And as a result of those two factors, we do expect growth to succeed by a wide margin, sort of our long-term projection that potential output in the US is about 2%. But there are three factors that put a damper on this outlook. So first of all, there are uncertainties about trade policy, both in terms of the content of future trade policy and also how long it's going to take before businesses have some knowledge about what NAFTA and what the US-China bilateral trade relationship is going to look like over the long term. Both of those factors may contribute to a decrease in investment growth. In addition, recent declines in major technology stocks, that could cause firms, not just in the tech sector, but throughout the economy, where you're seeing more and more investment in things like cloud computing and artificial intelligence, to slow down because some of those data-centric business models, it's not clear what the future regulatory landscape might end up being. And then finally, as Abdul and Eric already discussed, there are concerns that the pace of acceleration in Europe and in emerging market economies may slow. That may provide less support to the external environment and reduce export growth for the US.
Brian, just a quick question. So, okay, so you're going to come to this one. So
go ahead, ask your question.
No, the question is about the consumer confidence. So this is very high, right? Because in the United States, it looks like it's historically high, the levels of consumer confidence at the moment. So what explains it? Is it because of the improving labor market in the United States?
So I think absolutely. And what this chart shows here is, first of all, in the red line, consumer confidence, which is still very close to its highest level this century, despite a very small decline in March, and also CEO confidence, which, consistent with most measures of business confidence in the green line, is at a very high historical level. And I think, Abdul, you are absolutely right that the labor market plays a key role in explaining why consumer confidence is so strong. It's true that wage growth acceleration has not picked up quite as quickly as might be expected, given 4.1% unemployment. But on the other hand, when we look at measures within our consumer confidence survey, for example, our labor market differential, the differential between the share of respondents who think jobs are plentiful relative to those who think that jobs are hard to get, that number is remarkably positive right now. And so you can see that a labor market in which finding a job is relatively easy is boosting consumer confidence. A business environment where investment growth is growing quite quickly, where consumer demand is relatively strong, where businesses still feel like these tax measures are going to improve their long-term profitability, that's driving business confidence. And as a result, our baseline forecast is for GDP growth to continue at around 3% through the end of 2019. Getting back to the labor market, it's important to remember that right now, despite a fall off in March job creation down to a level of around 100,000, 3, 6, and 12-month averages are quite strong given a late stage in the expansion. That means that participation rates are improving, both in terms of the key 25 to 54 prime working age sector, and even overall participation rates have plateaued despite the fact that large numbers of Americans are reaching retirement age. So ordinarily we'd expect that overall participation rate number to be declining.
I would just say in this context that Brian just wrote a nice blog on the potential for further employment growth in the US. So I encourage our viewers to look at this blog and learn a lot from that.
Thank you. No, I mean, I think the key point in that piece is that employment growth can remain quite strong even in late stages of expansions until it's quite clear that a recession is coming, that our leading economic index, which I cannot urge all of you enough to pay close attention to, because when that starts falling, that's when real cutbacks in terms of employment and a slowdown in terms of employment growth starts to kick in and starts affecting the economy. So that's something to definitely watch out for. What this chart is showing is, first of all, the blue line, which is the unemployment rate. That is at its lowest level this century. I know I've said that a number of times. That gives you an idea of where the overall economic environment is. The green and red lines are measures of wage growth, basically the average over the past year compared with the last year. And you can see that both of those measures have certainly improved since the depths of the Great Recession, but given low inflation growth, a lack of productivity, and also the fact that more and more employees seem to be coming into the labor market, some of those wage growth numbers so far have not accelerated to the extent that we might otherwise expect given supply and demand conditions. If those start to pick up, that's going to feed into even more consumption, and that could be a potential upside for the forecast. Turning to inflation, key development this morning, as you can see the red line, the year-over-year change in core consumer price index that did rise back above 2% for the first time in a year. Keep in mind, though, that last March there was a downward adjustment as a result of a decline in monthly mobile phone prices. We knew that would ultimately go out of the sample this March. So I think sort of that dip that you see, a lot of that is because of this decline in mobile phone prices that didn't really reflect overall pricing conditions. So I think the overall picture in terms of CPI is a little less dramatic than what you're seeing here. Still, you're seeing that expectations of inflation, the difference between nominal and real 5-year bond rates, that number has gone slightly above the 2% target, though it hasn't risen much over the last month or two. Key measure to keep in mind when you're thinking about Federal Reserve policy is the core PCE measure, and that's in the blue line. That is still substantially below the 2% target rate. So I think what you're going to see this year is that there is more concern about inflation. Markets tend to think that the Fed is going to act swiftly enough in order to cut off the possibility of inflation rising much above 2%. And so I think you should expect around 4 rate hikes just because the economy is in a strong enough position to deal with those rate hikes. The Fed is looking also to accumulate ammunition as in the event that another recession should occur. So the higher they can get that policy rate before the next recession, that's going to be critical.
Now, let me just make a couple of comments on inflation, because I think this is one of the main developments in the last months, and it will have a big impact on the Federal Reserve's policy decisions. First of all, the blue line here, it doesn't include the March data, and we should expect a bump in that number as well, for the same reasons that Brian mentioned. The red line jumped in March, and it will get us pretty close to the 2% target of the Fed, and probably at 2% in a few months. And that is, it could be significant, because one of the things that held back the Fed in recent years was the fact that inflation was not a concern. But now, with inflation reaching back to the Fed's target, plus a tightening labor market, the Fed may feel more freedom to raise rates. Another reason why the Fed and others are concerned about inflation more than they were a month or two ago is that the producer prices are accelerating much faster than consumer prices. So the core producer prices are now growing at 3% year over year, which is quite significant. It's not clear how much of it will pass to consumer prices, but it certainly, other things equal, faster growth in producer prices mean faster inflation for consumers as well. So I think that's certainly a topic to watch very closely, and I think in one of the, perhaps even next time or 2 months from now, we will devote more time to the topic of inflation in our economics watch.
You know, actually, if I can interrupt, Brian, you said something pretty interesting, and I was hoping you might be able to expand on it a bit. In terms of where the Fed needs to be in terms of rates before the next recession occurs. So, you know, we're seeing, you know, a rates, you know, going up over the last year, and continue to see them most likely rise this year, going forward in this year as well. But I mean, how much sort of cushion, you know, is needed or could be needed to make the Fed feel more comfortable with trying to manage an economic downturn that comes in 1 to 2 years from now?
So if you assume 4 rate increases this year, Eric, so that would be 3 more during the rest of this year, and then 3 more next year. That's our current forecast. That gets you to around 3%. That's still well below the policy rate heading into the Great Recession, but I think that would give the Fed more room for maneuver. I have no way of knowing how deep the next recession may be.
Of course not.
So it's unclear. I think the Fed's answer would be as much cushion as we can get so that we have as much ammunition to throw at the next recession. It's also possible that some of the unorthodox policy measures that were introduced this recession may return once again. Right. And speaking of things that are worth watching in terms of thinking about scenarios that could generate a future recession, I think it's important to look at this chart that compares key technology stocks, so an index composed solely of Facebook, Amazon, Apple, Netflix, and Google, and Microsoft, and the rest of the S&P 500. The former, the blue line, you can see that decoupling from the rest of the index that began late in 2016, where while both parts of the stock market did quite well, certainly those 6 technology stocks did extraordinarily well. And you can also see that going back to late January, when the market as a whole began declining due to concerns about inflation, tightening labor markets, and possible step up in terms of Fed policy movements, the technology stocks continued to rise and quickly set new record highs. However, in early March, the Cambridge Analytica stories began to emerge. And the results of that, I think, are perhaps short-term in nature in terms of what's happening to this index as a whole. You're already seeing some recovery over the last few days. But I think the story bears watching because these companies have models that are centered around the use of customer data. Stories like the Cambridge Analytica story, those are going to cause customers to become more concerned about how is data that I'm providing these services being used. And so that key aspect of those data models is going to become riskier. It could be subject to more regulation, as is already happening in Europe. And so I think it's going to be very interesting to see how this story plays out. Will there be more demand for more strict data privacy and data protection regulation in the US? How exactly are those policies going to change? And that could affect the investment behavior of both technology companies and non-technology companies that still realize how important the use of customer data is in terms of building out future business models.
Yep. No, that's certainly, you're right, something bears watching. And again, I know that probably some of our audiences are watching this webcast at the same time they're watching the Zuckerberg testimony. So so the people are
We're
watching.
competing with Zuckerberg.
So our this is the slide of our forecast. We had a bit of an update. So first of all, we lowered our projection for the first quarter of 2018 simply because now most of the data is coming in, and it's coming in a little more slowly than or lower than expected. But in recent years, the first quarter was always weaker than other quarters, so it wouldn't, even after seasonal adjustments, so there was some residual seasonality left there, so we don't want to put too much weight on that, especially since confidence and sentiment measures remain very strong. We did lower our second half forecast a little. We don't want to make too rush decisions about the impact of the trade and the drop in stock prices, but we don't want to ignore it either. So we lowered our forecast a little. We will lower it again if we see that those things have more sustainability in them. But at the moment, we are still projecting solid growth, or more than solid growth, in 2018 and 2019.
I think the two areas to look at are, first of all, non-residential investment growth was lowered as a result of some of the concerns about both trade policy and technology stocks. And then also exports as well were lowered both because of the declining, possible plateauing of global growth, and also some of the concerns around trade policy. And I think with that, the question is, what is happening, Eric and Abdul, in terms of trade policy? And how should firms think about trade data in order to inform business strategy?
Well, Brian, you've asked a very, very, very big question. And Abdul and myself and a number of other people at the conference board have been thinking about this for over a year, really. We've made some great strides in research and recently published a new report called Trading Up, where we really try to peer under the hood of global trade and look at things through a different lens, and that lens being global value chains. So that's something that we're going to talk about during the remainder of the webcast. In terms of what's occurring between what the trade policy looks like out of Washington, that's actually more complicated to talk about. We at least have data to talk about global value chains and sort of big picture macro trade trends. But with respect to U.S. trade policy, My data points are usually limited to, what's the Twitter limit? 36 letters, characters?
280 now.
280, okay, wow, okay. Maybe I need to tweet a little more often. I can't remember that number. So trade has been on the agenda in the White House really since Trump came on board last year. The vast majority of his attention, however, in 2017 was focused primarily on NAFTA. We saw a lot of action and talk about that in 2017, and not as much about China. We did start to see sort of him and his administration begin to prepare, though, for a fight. And we wrote about this last year as the USTR launched a Section 301 investigation on China, which essentially looks at China's policies with respect to intellectual property and things like that. So we saw him picking one fight last year, and we saw him sort of preparing to pick another one this year. And lo and behold, as much as I like to be right, I was kind of hoping to be wrong on this one. Thus far in 2018, in January, we saw the announcement of a set of steel and aluminum tariffs under Section 232 of U.S. Legal codes. This has already been implemented, and China's responded already with $3 billion in tariffs, mostly on agricultural goods. Then just last month in March, we saw the results of the Section 301 investigation that I just referenced, and a set of about $50 billion in tariffs that the president has not implemented, but is currently exploring. USTR has put out an initial set of Chinese imports that it believes it will target. There's a 30-day period in which the public has the ability to comment on those, and businesses in the U.S., and then another 30 days after that until they would actually be put into place. So, in response to this, the Chinese have sort of announced their own sort of set of prospective tariffs for $50 billion as well. So this is sort of the window that we're in right now. The U.S. has sort of said, this is what we're going to do, and the Chinese have responded, this is what we're going to do. And now, hopefully, there's a good amount of negotiation that's taking place between policymakers in Washington and in China. Certainly, the Trump administration has said numerous times that the primary thing that he's trying to accomplish is sort of reciprocity, market access for U.S. companies, and of course, taking care of these IP thefts that he's been talking about for quite some time. And he's made overtures to China about, she and I are good friends, and we'll always be good friends regardless of what happens. So we're hoping to see some progress. We don't see a trade war as being imminent, but we don't really see a trade peace either. It'll be somewhere between the two. We continue to believe that there will be some sort of negotiated settlement that's achieved at some point in the future, and one that hopefully accomplishes some of the goals of the Trump administration as well. So that's a sort of quick take on what's been happening on the U.S.-China front.
Eric.
Yes.
So President Xi made a recent statement. How did that statement shape your view in terms of the overall risk of a trade war, and also what concessions China might be able to make in terms of trade policy?
Well, one of the complaints that China has made is that it doesn't have a firm understanding of what it is the Trump administration wants. I don't know if that's true or not. That may be something that they're saying publicly, but privately, the Trump administration may have been, quite specific about his goals. In terms of Xi's speech as of I think about 24 hours ago or so, there were some announcements made in terms of opening up the financial sector more, opening up the insurance sector more, reducing tariffs on automobiles. None of this is game-changing. None of this is brand new. And to be honest, none of it, from what I've heard, has really been sort of embraced by the business community that's operating in China. Now, the degree to which this has been sort of spun by the Trump administration as an early win in that, they're capitulating to our demands. That may be the optical way that this is being presented from the White House, but in terms of substantive policy changes, it's not there. Having said that, it's the first statement that we've seen that's been sort of an olive branch as opposed to a stick, as opposed to announcing another set of tariffs that the Chinese would potentially put into place or that the Trump administration may put into place. It's going in the other direction, and that's, of course, a positive thing.
Well, I would say, one of the topics where conference board members are continuously furious about in the presentations that I gave over the year is the unfairness of trying to expand in China and the relationship with China. So this is perhaps why you see that this initiative is actually pretty popular in the business community in the US.
Yeah.
What do you think is the likelihood that the end of this will be actually a good outcome? No trade war and a significant change in or improvement in the ability of US companies to do business in China?
I mean, that's the goal. I forget my crystal ball today, so I can't look into the future and tell you and quantify sort of probabilities. I'd say from my own perspective, there's maybe a 20% chance that we'll see a positive outcome like that, maybe a 60% chance that we'll not see much of anything coming from this, and then a 20% chance that we'll see a total trade war that hurts everyone. So I guess my expectation is that we're probably likely to see nothing hugely meaningful and concrete come from all of this. Mm-hmm. But there is the potential for upside, and of course there's potential for very, very big downside as well.
Yeah. Okay. Well, so in addition to the recent drama with China, we did a lot of work. Oh, wait. First, we have an audience poll question. So, the studio, maybe you can put, yeah. So this is the question. During the past 5 years, has your firms sought to restore production activities closer to consumers?
Reshore production.
Oh, okay, there is a typo here. So reshore, not restore. Reshore production activities closer to consumers. So let's let the audience read and think. So let's give it 5 more seconds. 5, 4, 3, 2, 1, 0. Okay, so there is a large majority of those saying that they did not take action to reshore productions. But even if close to quarter say they did, that's also meaningful. Does that the numbers here, do they surprise you, anyone?
I mean, we've been looking at this. One of our Abdul and I, our colleagues, Hilaria, has done some initial research into trying to tease out the reshoring trend, and without sort of giving away the punchline of her her report, we are seeing some movement in this direction in terms of reshifting of supply chains, trying to get closer to consumers. It is a trend that we believe is real and that we, to some extent, can quantify.
Mm-hmm. Okay. Good. So, Abdul, I'm leaving you with less time than I hoped for, but because this topic deserves more time. But you and Eric and others done a lot of work on the kind of more structural trends about global trade, and what are some of the main takeaways?
Yeah, Gad, so as you said, we don't have a lot of time, so I will try to be brief over here. First of all, after the financial crisis during the 2008, 2009, especially after 2011, the global trade growth has been moving at a very mediocre pace. And but then the good news is that since the end of 2016, global trade growth started improving, and it has been growing now. So that's indeed a good news. But the biggest question is that whether that acceleration in the growth in global trade will continue or not. So we believe, and our research suggests that this improvement in global trade growth is temporary, and it is a cyclical response to the uptick in investment and consumption, and that lead to the global GDP growth overall, across the globe in advanced economies and also in emerging economies. And this is also quite different from the pace of global trade expansion, which we have seen in the 1990s and 2000s, where global trade growth was driven significantly by rapid improvements in technology, like information technology, which reduced the transaction and communication costs significantly. And the opening up of, or the inclusion of large emerging market economies like China, which had significant manufacturing infrastructure and a larger market for durable and tradable goods. So the integration of these into global trade organizations and opening up of these economies into the world market has expanded avenues and opportunities for global trade. And finally, additional and incremental improvement in transportation technologies, which has been already happening in terms of shipping technologies and air transportation technologies, that also accelerated global trade growth in the 90s and 2000s. But now looking at this, what is happening to these factors, we don't see much happening there. In fact, what we see is actually negative aspects, like China is changing its production and consumption composition from tradable to non-tradables, like to service, from manufacturing to services. And also we see a decline in the intermediate goods trade. We will talk about it a little bit later. And technology is actually playing a different role now. As we have seen in the poll earlier, even though it is 20%, that means there is a momentum in terms of shifting production back to home country or back to where the consumers are, which is aided by technology in terms of artificial intelligence and robots, which are facilitating replacement of cheap labor, which was one of the reasons why outsourcing took place in the past. To buy using robots, you can replace cheap labor and save cost on that. So routine jobs can be automated, and that helps bring back production now. And so, given the fact that much of the recent cyclical uptick in global trade has been a response to global growth, given the fact that we are predicting global growth to remain strong, but not significantly high, and it is not going to last longer in the medium to long term, we are not seeing significant prospects for global trade to flourish in the coming years. Mm-hmm. So some of the factors which includes which makes us think in this way includes the soft fall in China's economic growth, which we are forecasting, because China is already seeing a decline in its economic growth, and that momentum will continue in going forward. And as I said earlier, there is a significant trend in the global consumption pattern from more tradable, durable goods like manufacturing goods to more services, especially in emerging markets economies, large emerging economies like China. And technology is playing a significant role in bringing back production. So I already have explained some of these things, but one additional thing is that as Eric was earlier discussing the trade war and the possible trade war, and also the increasing global anti-globalization sentiments across the globe, which can accelerate the third point, which is the role of bringing back production to the advanced economies and close to consumers by using technology and other things. So there are a lot of factors that can actually play against global trade growth momentum in going forward. Eric, you want to add anything to what I have said so far?
No, I think you've done a great job, Abdul, in terms of identifying the core drivers of the sort of trade bonanza that we saw in the 90s and 2000s relative to sort of how it's different than what we've been seeing recently.
Yeah. So what I'm giving you now is basically a brief summary of what we will see in detail in the next slides. But the implication of these change in the pattern of trade or the future of global trade for companies is that they will have to think about their strategies in terms of their structure of global supply chain, whether motivations for outsourcing their tasks and their production activities to other countries, whether that has to be reconsidered and whether those motivations still remain or not, and also their location decisions. So to which country or to where they should be producing, whether they should shift back their production back to their consumers, close to their consumers, or they should look out for other countries, like for example, now China is facing an increase in its wage cost, and so other countries like India or Vietnam could be better alternative for their location decisions. These are the kind of strategies which they should be re-evaluating, and for this decision making, they should be focusing and they should be depending significantly on global value chain data. What I'm saying is that. So in the conventional trade statistics, we were looking at gross exports and imports. These data are not informative when you come to the decision-making process of outsourcing part of your production.
Abdul, thanks. I just want to be conscious of the time, and we have just a few minutes left, so maybe we can devote those to. There's a lot of resources and tools on that topic from our work at the conference board. So maybe Eric or Abdul, do you want to briefly talk about those and how our members could use them?
Sure. So, I mean, we have a number of slides here that unfortunately we're not going to have the time to go through. But I think it's important that we expound maybe a little bit on something that Abdul just mentioned in terms of looking at trade through a different lens and the importance that lens has already really been playing over the last several decades, and our recommendation that business leaders start to get away from these sort of antiquated metrics that we read in the newspapers every day about gross trade numbers, about bilateral trade deficits as measured by gross exports and gross imports. These are metrics of a foregone era. We're no longer loading finished goods onto ships and sending them to Panama or to Germany. There's a vast flow of intermediate inputs, components that are flowing from one place to another that are carving out global production networks. And so being able to really sort of analyze those in a way where you stop looking at just sort of what's put on the boat where, but understanding how the value is actually flowing across borders, we believe is very, very important in understanding how trade works these days. So as you can see in the chart, we have a database that we've put together in which we have sort of peered under the hood of about 40 to 50 countries and really looked down at a granular level at manufacturing industries in each of those countries and being able to look at the degree to which the output from, let's say, the U.S. automobile industry is reliant on Chinese intermediate inputs. So especially given the current trade environment where everyone is worried about these tariffs being put into place, manufacturers in the U.S. that are sourcing, let's say, a wire harness that's made in China could see the cost of that wire harness go up 25%, which would impact, of course, their business. So being able to look on a granular basis and see, for this sector, my supply chain is 30% reliant on China, can help you have a better understanding in terms of what the potential impact for this kind of event could be. And you can take this tool and really apply it to a lot of different concepts and strategic sort of insights for your business.
Good. And I just, before we conclude, I just wanted to show our viewers that we have a page devoted to resources on trade-related work that we did and others, and it's right here. You can click on that and it will take you to that page. Just before concluding, to remind you that we will have the same cycle of products related to Economics Watch in the next months. And there will be, on May 9th, there will be our next economics watch, and it will be about tax cuts, spending, and the outlook for 2018. We'll have Ilaria Maselli and Joe Minarek here. We'll also have other publications that are always for you to read and learn from. I want to thank Brian, Eric, and Abdul for joining me today, and I want to wish you all a good rest of the day. Thank you.